Thanks. Questions, reflections on this or any other matter for that matter that's in the report?
The conference has been unmuted.
You start, sir. Everything is crystal clear. I can't imagine. Yeah.
Yeah, has the report from the Department of Financial Stability regarding the housing market had any effect on the decision today?
Well, that's also part of the picture, but in terms of the signs here, one can say that this is kind of a standalone piece which speaks for itself. Given what's going on when it comes to household borrowing, also from that perspective, it's not wrong to raise the rate.
You mentioned that unemployment tends down to about 6%. That's about where it bottomed out last time. And so I assume that you see the rate of capacity utilization in the labor market about the same. But you also have a little bit about other labor markets, US for instance, where you have NIRA trending upwards. So what's your reasoning here? Did nothing happen in Sweden that would have changed the NIRA, or was it the confluence of events that just happened to keep it about the same?
Looking at it from another way, or trying to answer your question, but picking a little bit of a different sort of starting point. When we went into this difficult episode, we knew what happened in the 90s, but then we had negative growth for several years, and unemployment went much higher than where we ended up now. Given our past history, that history told us that unemployment would peak at a much higher level than where we ended up, let's say around 11%. Now we had a very large drop in aggregate demand, basically coming from the rest of the world. And then we have a very quick bounce back. And in the meantime, people were not laid off to the extent that we expected. And with that background, then one would expect that it's a bit easier for us to bring the economy back to something that looks pretty normal compared to if you go through an episode where you have all sorts of pretty grave macroeconomic imbalances that you have to live through for many years. So in that sense, one can argue that we were very, very fortunate during this particular downturn, and that has been quite helpful actually when it comes to our view on unemployment presently.
Can I add on that perhaps that I mean, this is an important and difficult question, but I guess that, and I think it's still debated even in the US to what extent the upturn is more cyclical or structural. I guess the main view in the Fed still looks like to be that it's mainly cyclical or something, maybe even entirely cyclical. But I think, but there's some emerging studies that tend to suggest that there's some structural upturn in this. I guess one argument for that in the US is that they have a lot, I mean, they're sort of, I don't know if you want to call them the epicenter of the crisis, but a little bit like that, and they have severe structural problems, I guess, in their, both in the financial market, of course, and also in the housing market. And I guess the main reasons then for this structural upturn in the US would be there. But in the case of Sweden, this time, fortunately, unlike the 1990s, we were hit more by a huge export shock. That could also create persistence effects in the Swedish labor market just because of the size of the shock. But it was then the case, I mean, we made originally a forecast of unemployment, I think, around 11%, which would have been in line, basically, with the forecast we predicted for output growth. The forecast for output growth turned out to be wrong. Output turned out to recover better than we assumed. But even with the actual numbers of output sort of put into the picture, the labor market, I guess, in Sweden has surprised on the upside, and unemployment has turned down much quicker than we thought, and than what the actual growth number would have said. So And what you can see then, if you look at the sectors, is I think there's a good recovery going on, in particular in construction and in services, but there's a less good recovery going on in manufacturing. I think here maybe there are risks. What will happen to, I guess, manufacturing industry has recovered something like 20%. There are risks here. Will this recovery continue in the manufacturing industry, or what will happen to these people? And that's a key factor, I think, going ahead, to see whether we will have some problems or not. But so far, it looks really like there hasn't been too much structural things going on, I think, in the Swedish labour market, but more a traditional shock and a better recovery than we thought.
In the short run, I'm talking 2011, I see the increase you've made to your inflation forecast basically matches the increase in your repo rate forecast. So is this really tightening in the real sense? The real repo rate is still very low, considering the utilization we're having, and output gaps might be closed.
Is the question whether the real rate goes up in the forecast?
No. I'm saying is that the real rate is quite low considering the situation, and the increase you made in the repo rate forecast is matched by an increase in inflation or your inflation forecast. So the real rate doesn't really increase in that sense.
It increased a bit.
Oh, okay.
The inflation upward revision year 2 and year 3 are really tiny, but that's exactly because the interest rate is tightened to counteract bigger effects feeding through as we go ahead. But it's true that it's not a very huge real interest rate increase, and it's also true that the level of the real rate is still low, yes.
And if you look at kind of the way we presented our views in December, most of the numbers are fairly close to what we thought then. So in that sense, one can argue that there's absolutely no major drama this time. We are really talking about minor revisions here and there, including the repo path.
Yeah. How much above the ECB do you think it is possible to go without ending up in the stronger currency scenario? I mean, like repo, refi spread.
No, there's nothing sort of mechanic about that. We've said many times that to do exchange rate projections, that's very hard to do, and we know that we have quite large fluctuations in the exchange rate in all sorts of directions. So basically, this time we have done a very kind of standard way of doing the projection. But having done so, then also you need, as Pat has pointed out, you need to sort of reflect on what's going on in the economy as a whole, what's going on in the rest of the world, and not only tie everything to the interest rate differential. When you do the modeling, which is a sort of a bit different, then in the modeling world you have to make assumptions about these things, and it's easier in the modeling world to have sort of almost everything kind of driven by the interest rate differential. So there you end up with sort of different types of scenarios. But I wouldn't sort of put a number on this, saying that if you get to that number, then things have changed dramatically, because at the end of the day, if that were to happen, that depends on what's going on in the economy as a whole when that day comes.
Can I just add that if you compare the interest rate levels that we have for Sweden and other countries with what is being priced into the market, it's true that our levels for both are higher than what is priced into the market, but the differential is basically the same. So basically that means that our forecast is conditioned on the same differential, even though the levels for both are a bit higher, because we are a bit more conservative when it comes to when policy tightening is needed. But therefore, the differential currently priced in is also what we have, and that's assumed to be consistent with the main scenario. Of course, but if the differential then widens further or something, then that might, of course, have implications for the krona.
So In the modeling, you are basically using the implied market spread, and not a
We're not
forecast
using
of
it,
these.
but it so happens that the differential that we have in our forecast is the same as in the implied forward rates.
Maybe one issue here when you're talking about interest rates is that when you do the modeling, you have basically 4 different rates to choose from. You have the domestic implied rates, you have our own path, you have our own projections when it comes to foreign rates, and you can use implied rates, and then you can combine them any way you want. But Per's point is kind of if all these rates in one way or the other happen to move up more or less in parallel, which is a bit what has happened lately, then I think that the final outcome doesn't really change all that much. What we prefer to do, though, when it comes to the modeling, or at least this is the majority view among the board members, is to use our own projections, our own path when it comes to our own repo rate, and also use our own projection when it comes to our view on what's happening with various rates in the rest of the rest of the world. One can always argue about that because there are many different ways of doing this, but at least in our view, it's a consistent way of doing it.